Andy, when they're talking about real estate leverage or leverage in real estate, what does that mean?
That's a good question. Leverage is kind of one of those terms that people like to throw around a lot, but effectively it's where you buy a property with a little bit of money down. Let's say 10% or 5% or 20%. And by putting that money down, you're able to buy more than that. For example, let's say I want to buy $1 million apartment complex. One way to buy it is write them a check for $1 million if I have $1 million in the bank and I bought the complex debt free. But you're not really leveraging your capital in doing that. I may have $1 million and I may buy a $1 million property, and let's say it generates $100,000 in return every year. Okay, that's just like leverage of, let's say, 1 to 1. But if instead of that, let's say I use that $1 million to buy $5 million in property. Okay, put 20% down, which is a million, and bought 5 million. Or let's say I bought 10 million. 10% down. Let's say I had a bank that would do a 10% deal, and I bought 10 million in property with that same $1 million. Now, on a 10% cap rate, assuming you bought similar properties, that 10 million you'd expect to generate $1 million annually in net income. Whereas if you bought $1 million debt free, you make 100,000. You buy $1 million with leverage, you make $1 million. Now there's one problem: you got to pay the debt. You've borrowed $9 million in this example, this theoretical example, and let's say that payment on $1 million, if you got a favorable interest rate, might be $700,000 a year. Let's just say. So the net of it is you made $300,000 by using leverage. You took that million and you kind of multiplied its effect. And so even though you're having debt service, you've taken what was a $100,000 return on a $1 million just cash debt free, and you've leveraged it into a $300,000 return by using the magic of by financing. Now here's where it comes into problems. If you're assuming that debt is going to be okay, or that the property is going to stay occupied. When you have debt on a property, you put your principal at risk, because if you have a problem with the property, the bank's going to still want to be paid.
Right.
Whereas if you pay for something debt free, no leverage, let's say, if you have a problem with the property, you just hang on to it till you get the problem resolved. When you have $9 million in debt, if you have problems, that bank's going to be calling real quick to get that fixed. So it puts a lot more pressure on you to get leverage, but the benefit of it is you can get a multiple return on your investment.
So it's good to have a trustworthy relationship with your lender, obviously.
Yeah, you got to have a trusting relationship with the lender, but that only goes so far. That'll basically get you into it. You really still got to do your groundwork. Really still got to make sure you're managing it right. Make sure that your numbers are correct, and you got to buy right. If you overpay for a property, the leverage goes away, and you still lose your shirt. The numbers always tell you what to do in a commercial transaction. Leverage is just a way for a smart investor to take some equity or some capital that he has and multiply its effect and get some good, bigger deals done.
Well, how would you know how far you can leverage before you put yourself in a dire risk situation?
Now, it's a good question. It's tough to know. The bank will stop you from going too far, usually, although you see the subprime mortgage crisis, which is an example of infinite leverage, to where people don't put any money down and can buy a $250,000 property. But usually with commercial transactions, banks want to see 15–20% down, some as little as 10, but usually a little more. So there's kind of a built-in brake system, and that's because they understand that without some equity in the deal, as a buyer, can walk quickly and the ratios don't work. So usually the banks want to see something, at least for the first couple years, and then there's a potential opportunity to refinance out your equity.
Do people usually make careless decisions and try to go one bank here, 10%, 15% down, and then really put themselves in bad situations, or do banks usually catch on to that?
Yeah, no, there's a sense that it's really a torn dilemma, because the banks are in the interest of loaning money, so they're kind of motivated to sell. Especially the mortgage companies. The buyer wants to buy it, so everybody wants it, even if it may be a bad thing. The bank wants to do the loan, you want to buy it, so you can't count on the bank to protect you. You still got to make sure, in a down case scenario where you have high vacancy in a property that you just purchased, can you still sustain the mortgage? If not, you put your principal, your equity at risk. And so, you know, I would say 5 to 1 is a decent multiplier. Meaning, if you had $1 million, you'd buy in the $5 million range. And the banks historically, that's kind of what they want to see. And that's just to protect you as an investor. You may feel like you're not being protected and your bank isn't serving you by not loaning you $10 million or $20 million with $1 million in equity. But in reality, long term and historically, they are protecting you.